Uber CEO Dara Khosrowshahi reported a record quarter for the world's largest ride-hailing business. Global trips grew 24% versus last year to 2.1 billion, or approximately 24 million trips per day on average. That's a lot of rides. Revenue was up even more, 29% to $8.8 billion. Khosrowshahi and the Uber team are hitting on all cylinders. The massive scale of the Uber platform has created significant advantage versus Lyft and other rideshare players. Uber successfully navigated through the pandemic and multiple regulatory challenges as well. And while regulatory issues may never be completely resolved, Uber's built confidence it can negotiate its way through. The company's also focused on extending its product with new offerings such as reserved rides. That product has proven to be so popular that 20% of Uber's airport drop-offs are now reserved in advance. Let's listen in as Khosrowshahi reviews the strong first quarter results and Uber's outlook for the year ahead.
Uber's off to a strong start in 2023, with gross bookings up 22% year-on-year constant currency. Trips outpaced gross bookings growth and accelerated to 24% growth from 19% last quarter. Adjusted EBITDA of $761 million exceeded the high end of our guidance, and we delivered strong incremental adjusted EBITDA margin of 12% and record free cash flow of $549 million. Despite any macroeconomic uncertainty, I'm more confident than ever in our prospects and remain committed to best-of-breed cash flow growth. The Uber platform has never been stronger. Our own expectations have never been higher, and we're excited to leave no doubt as to the scope of our ambitions for exceptionally profitable growth. With that, let's open the call to questions.
Our next question comes from Brian Nowak from Morgan Stanley. Please go ahead. Your line is open.
I'd be curious to hear a little more detail about which use cases or products are sort of driving this strong new user cohort frequency and spend behavior that you're seeing. And then the second one on delivery, you're talking about acceleration in the business, really healthy. Can you just talk to us about which products or regions are driving that acceleration and how we should think about that over the course of the year? Thanks.
Yeah, Brian, in terms of the mobility cohorts, which are positive kind of on a year-on-year basis, and then the newer cohorts are actually even more healthy in terms of trip frequency, it comes really from the amalgamation of all of the work that we are doing on the platform. Supply is strong, ETAs are coming down, surge came down from Q4 to Q1, and that's resulting in higher conversion rates in terms of how many sessions does a rider have, and do they convert on that session? So the quality of the marketplace is clearly having an effect, but at the same time, we're innovating and we're adding a ton of new products and choices for the rider as well. Reserve is an example. I talked about 20% now of our airport drop-offs being reserved trips, and what we're finding is that Reserve has a combination of riders who used to use our on-demand marketplace, now using Reserve to make sure that they're kind of guaranteed availability or guaranteed a much higher reliability. But it's also bringing new riders into the system as well that are, it's a use case. Travel is a strong use case with high average fares as well. So I think it's a combination of marketplace health and innovation around new use cases that is driving the frequency that we are seeing. In terms of delivery, as far as the growth there and the acceleration drivers, one is just that we had Omicron comps earlier in the year. So if you look at January, delivery volumes were a bit lighter just because of comps. And then we saw acceleration going into February and March, and we expect strong growth for the balance of the year. And the other factor in terms of delivery is, again, the customer cohort data is actually quite healthy. Eater retention has improved significantly, so eaters are staying with the platform. Frequency is up, and a higher percentage of our eaters and riders, but especially eaters, are members. and as you know, members spend 4 times the amount that non-members do. So all of that is adding up to continued healthy growth for the platform, both on the mobility side and on the Eats side as well.
Our next question comes from Eric Sheridan from Goldman Sachs. Please go ahead. Your line is open.
Maybe following up on that with 2 on the delivery side of the equation. Dara, you called out in the letter improving your category position in large markets. Can you give us a little bit better sense of what you see as the key investments to improve category position are, and how investors should think about the growth output or the yield from those investments looking out over the medium to long term? And then second, with respect to the delivery business, how should we think about market share dynamics broadly in the delivery business versus where you see yourself as the best positioned to compete, where there's an overlap between the Uber One subscription and the mobility business, where that might put you on a competitive footing that's different than markets where that may not be as prevalent? Thank you.
Yeah, absolutely, Eric. So I think on the delivery side, we're seeing the result of a couple of factors. First of all, we've got the power of the platform in that we have our mobility business that is actively upselling our mobility customers to our Eats products. The audience that we have on the mobility business is the largest audience in the world in terms of any of our mobility competitors, and we're the only scale players who are kind of upselling from mobility to delivery and then vice versa. So against our competitors who are monoline competitors, who are delivery-only competitors, we have a source of low-cost traffic, significantly low-cost traffic. Our mobility business sends us more customers than we get from Facebook and Google and Snap and all of these different platforms combined. And that's just a structural advantage that we have against the overall market, certainly against our competitors. And then I think we're executing particularly well algorithmically as it relates to improving our marketplace efficiency on the delivery side, higher percentage of batching orders, and using deep learning techniques to drive down cost per transaction on the delivery side. You add on top of that our advertising product, which continues to grow at high rates. Advertisers are up 70% year on year using our platform, and you get some pretty powerful economic drivers that's allowing us to deliver the kinds of bottom line that you saw on our delivery business, which is well ahead of estimates, while gaining category position in 9 of our top 10 markets on a global basis. So I think that it's happening broadly. It's not 5 out of 10, it's 9 out of 10 markets where we're gaining category position, and I do think it's the power of the platform. And again, we see it in almost every single market out there.
Our next question comes from Justin Post from Bank of America. Please go ahead. Your line is open.
I noticed you had some interesting comments on the taxi business. Just high level, how much that's helping your mobility growth. Thank you.
As it relates to the taxi market, we don't disclose, let's say, taxi bookings. When we look at hailables, which is taxi 2-wheelers, 3-wheelers in certain markets, that's a business that's already over $1 billion. But really, the way that we look at our portfolio is a set of growth bets that we're making. These are taxi, 2-wheelers, 3-wheelers, low cost, our UberX Share, high capacity vehicles that we're investing in, our Uber for business, Uber for health, and then newer products like Reserve that are creating entirely kind of new instances for our riders to use the service. If you add up all those growth bets, we're about a $6 billion run rate, growing at 100% year on year. So we talked about when we put together a growth platform, we talked about 50% of our growth coming from our base business, 35% of our growth coming from new bets, 15% of our growth coming from certain international expansion. It's the traditional Uber business, but with a twist. And if you look at our growth bets were about 10% of our volume in Q1. They're about 20% of our growth in Q1. And they also account for 20% of new riders coming onto the platform. So not only are they a big part of our growth and kind of a new business segment that we're building, but we're introducing an entirely new audience to the Uber platform, and those new riders tend to use other products. They'll come in on U4B, they'll use us mainline, they'll come in on low cost, and then they'll treat themselves to an UberX or Comfort as well. So we see taxi as a part of a portfolio. Nelson and his team are constantly allocating capital to the base business, to the growth bets as well in a dynamic way to deliver the kinds of top lines and then excellent bottom lines that you're seeing.
Our next question comes from Lloyd Walmsley from UBS. Please go ahead. Your line is open.
Thanks a lot. Two, if I can. First, just kind of continuing on the last question, appreciate the color on hailables and the new formats. I guess on that international side of the medium-term growth, what is the latest update on some of the markets you flagged at the Analyst Day, like South Korea, Spain, and Germany?
Yeah, I'll start. In terms of the international markets, a couple that I would call out are Spain, Germany, and Turkey. Spain is a highly regulated market, but we're having a ton of success in terms of adding supply into our marketplace. Earnings are strong, demand is strong, and Spain is growing at very significant rates, and we believe we're gaining category position in Spain. Same with Germany. It's a market that we started on probably around 4 years ago, and it has developed very well. We're playing by the rules, and Germany is the largest GDP in Europe, so it's a very, very large market to go after, and we're seeing promise both on the mobility side and the delivery side in Germany. We're happy with that development. A couple of other markets are Turkey, where Turkey is a taxi market, and our innovating around hailables and building a taxi product has allowed us to penetrate into that market as well. And then Argentina as well, showing real promise in South America. We're seeing with South Korea and Japan, the market development there is slower than we'd like, frankly, and it's partially because of regulatory issues as it relates to dynamic pricing, et cetera. We're not able to kind of flex all of the muscles of the marketplace of what makes Uber great, especially on the pricing side. We think pricing reform there will benefit drivers, so we think it's absolutely something that will help out the market, but it's taking a little more time than we would like.
Our next question comes from Deepak Mathivanan from Wolfe Research. Please go ahead. Your line is open.
Great. Thanks for taking the questions. Dara, your competitor in the U.S. is going through a transition currently. How do you think about the potential impact of this on the U.S. rideshare market? And philosophically, what is Uber's priority between kind of defending category position and profitability if, for some reason, competition intensifies in this space?
Yeah, and Deepak, as far as the trade-off between CP and profitability, the first thing I would say is, I hope that we have demonstrated over the past 6-7 quarters that that's a false trade-off. We've been consistently gaining category position, and as you've seen, we've been delivering on profitability at a rate well in excess of our internal targets and in excess of external expectations, right? 12% this last quarter. And, again, delivering essentially record adjusted EBITDA, $288 million in adjusted EBITDA, over 20% incremental margins, while gaining category position in 9 out of our 10 markets. And it's a combination of the team executing really well, our being the scale player, our being the global player, and our having the power of the platform that our competitors don't. As far as what we are seeing domestically with Lyft, obviously they're going through a lot of changes.